If you trade Forex, you don't need anybody to tell you that many of the popular currency pairs are in conditions at this time that can be really tough to trade. Sure, you can emotionally trade them and maybe get a winner, but for the past several weeks, finding great reasons to trade haven't existed. There's been some choppy price action, low volatility, momentum appearing and disappearing, and all of that combined does not make our jobs easier. There is a telltale sign that conditions are not great, and for that we can look at the US dollar index. For those of you that are unaware, the US dollar index measures the USD against 6 other currencies. Inside of that basket of currencies, the Euro US dollar makes up the bulk of the measure. So the top 3 currency pairs inside that basket are the euro, the yen, and the British pound. Those currencies are matched up against the US dollar, and they form the bulk of the trading activity anyways that happens in Forex. The dollar index is a good barometer of the strength or the weakness of the USD against other currency pairs, although the trade weighted index, it could be argued, is more relevant to the true strength of the US dollar. Adding the knowledge of the technical conditions of the dollar index can be part of your overall trading plan and help you assess which direction you wish to trade. This is the year-to-date US dollar index chart, and we can see that in the beginning of the year, the US dollar was weak against the basket of currency pairs. Price action pattern, it's showing lower highs and lower lows. You can also see that any price consolidations resolved into the downside. So if you bring up the euro US dollar or the pound US Forex charts, you're going to see that the drop in the US dollar coincided with the uptrending market in those pairs. There were some great trading opportunities regardless of your approach, unless you're picking the tops, and price was trending pretty well. Well, the weather shifted in early February. Upside momentum stepped in, showing the US dollar getting stronger as price began its rally. And if price would have kept moving, trading conditions would have continued to be fairly decent, but markets are never affected by what we want. And if you're familiar with technical analysis, trending markets make a stair-stepping pattern. But as you can see in the index, price sold off, it failed to make a lower low, and it got trapped between the two extremes. So this is when trading Forex, or any market, can become a little bit more difficult. When higher time frames are trapped between two extremes, lower time frame charts can have some trending moves that you can trade. For longer time frame traders like myself, while the first rally back to resistance was a good trade, the wheels came off the market, especially for those who focus on the trend. The market's still an uptrend on the higher time frames, but the larger range with the range inside of that range made the price moves less reliable. Hindsight on this chart is easy, but trading the hard right edge would not have been as smooth as hypothetical trading is. And I don't use much in the way of trading indicators, but an intermediate term moving average such as a 20 can give you an indication of trading conditions. This is a 20 period EMA on the US dollar index chart. That green star indicates when the euro US dollar put in a double top, and it wasn't long after the US dollar index put in a double bottom. Price begins to whip around the moving average, which indicates that price is in relative balance at this point. Markets that are in balance are tough to trade regardless of your trading experience. And while you can see the same thing with price action, using an indicator in this way allows you to be more objective, and it helps you quickly scan charts that are worthy of your attention and your risk. And if we look at the Euro USD with the 20 EMA applied, we see the same condition. Once price starts whipping around the moving average, much like the dollar index, stepping aside until the consolidation resolves is generally the better option. And you could trade the lower time frames, but for longer term traders, that would be an entire shift in their business plan. Now, looking at the US dollar near the end of March, although we've seen some movement to the downside out of the smaller trading range, we still have lows less than $1 away. Does a recent strong move in various currencies mean that consolidation's over? No, it doesn't. When markets are in consolidation, sudden momentum bursts are not uncommon, and oftentimes price will simply fall back into the trading range. We can never know with 100% certainty what the markets are going to do. We can plan for different outcomes and react when price reaches the zones that may be considered a tipping point, such as the higher low of a trading range. Combining the resolutions of the euro US dollar, the pound US, and the US dollar yen with the resolution of the dollar index gives you a double whammy approach to trading the top 3 crosses.